Welcome back to Talk Tickers. This is the deep dive where we try to find the real signal in all the noise of earnings season. And today we are looking at a print that, it honestly seems to defy the laws of gravity for a software company this big.
That's a good way to put it. We're breaking down Palantir Technologies, ticker PLTR, and their Q4 2025 results. And you're right, defying gravity is almost the perfect way to frame it.
How so?
Well, usually in software, the bigger you get, the slower you grow. It's just the law of large numbers. What we saw yesterday from Palantir was, well, the complete opposite. They're getting bigger and they're accelerating.
And the market definitely noticed. The stock closed around, what, $147? Then the numbers dropped and boom.
Yep, a 7% jump in after hours pushed it right past $158. And the volume was huge, something like 71 million shares traded.
But let's get past the price for a second. The management team used some pretty big words. I heard historic, monumental, even iconic. When a CFO says iconic, I usually start to get skeptical.
I know, but this time, the math actually backs up the adjectives. This wasn't just a simple beat. It really feels like a structural shift in their entire business.
Okay, so let's get into it. What was the headline number, the top line?
Revenue for the quarter came in at $1.407 billion.
Okay, $1.4 billion. Give us some context on that. What's the growth rate? Because that's what really matters here.
That is up 70% year over year. 70.
70% at their scale.
Exactly. And to give you an idea of how big the surprise was, the street's consensus was off by about $70 million.
So they beat what all the professional analysts were expecting by $70 million.
Yeah. In large cap software, beating by that much it's massive. It suggests the models everyone was using were just fundamentally wrong about how fast this is happening.
That's a huge gap. But for years, the knock on Palantir was always about profitability. The bears would say they grow, but they just burn cash or rely on stock-based comp. Did that argument survive this quarter?
That argument is officially dead. It's over. If you look at the bottom line, GAAP EPS, real profit, was 24 cents.
24 cents. And what was it a year ago?
3 cents.
So they 8x'd their actual profit per share in just 12 months.
Correct. We're talking GAAP net income of over $608 million. That is a 43% margin. And the free cash flow, was $2.3 billion for the full year, up 82%.
That brings us to a metric we talk about a lot, the rule of 40. Remind everyone how that works.
Sure. It's pretty simple. It's the health benchmark for a software company.
Yeah.
You just take the revenue growth percentage and you add it to your profit margin percentage. If that number is over 40, you're considered elite.
Okay, so 40 is the goal. What did Palantir score?
They posted a 127.
127. That sounds like a typo.
That's almost a broken metric at this point.
Yeah.
You have 70% revenue growth on top of a 57% adjusted operating margin. That's why CEO Alex Cart keeps calling them an N of 1 company.
Meaning there's no one to compare them to.
Exactly. Look around. Who else is doing this combination of hypergrowth, massive scale, and just gushing cash all at the same time? Nobody.
So the numbers are, frankly, insane. But we need to understand the why. What is actually driving this? Palantir's old reputation was the spooky government contractor, right? Is that still the engine?
It's still a huge part of the story, and it's accelerating too. But the real surprise, the thing that blew the models away, is the U.S. commercial business.
Private companies.
Private enterprise, Fortune 500. The total U.S. business is now 77% of revenue, and that U.S. commercial part grew 137%.
137%? That doesn't even sound like enterprise software sales. That's like a viral consumer app. How do you even close deals that fast? These things usually take months, right?
Yeah.
Legal, compliance.
They've completely changed the game with what they call boot camps.
Right, they're go-to-market.
It's a hack on the whole sales cycle. Instead of months of PowerPoints and steak dinners for the CIO, they get a customer's engineers in a room with their actual data for a couple of days, and they just build a working product right there on the spot.
So they skip the sales pitch and go straight to showing the results.
Exactly. And the data they shared on this is wild. Take Lear, the auto tech company. They started with a pilot, 100 users, 4 use cases, pretty standard stuff.
Okay.
After seeing what the platform could do, that expanded to 16,000 users and 280 use cases.
16,000. That's not adoption. That's the software becoming the central nervous system of the company.
It is. The chief revenue officer said customers are going from AI adopters to AI native. There was this quote from an exec at a construction company that said it all. He said, "We've gone all in. Every other software must justify its existence."
Wow. Every other software must justify its existence. That is a threat to every other SaaS vendor out there. It sounds like Palantir isn't just winning a piece of the budget, they're trying to become the entire budget.
They are. And that brings us to the tech behind it, the ontology.
Okay, yeah, we hear this word all the time with them. It sounds so philosophical. Can you explain it like I'm 5? What is the ontology?
Think of it like a perfect digital map of your entire company. Not just the data, but how everything connects. Most companies have their data in different buckets, right? Sales data is over here, HR data is over there, factory data is somewhere else.
Right, total silos.
The ontology maps how all of those things actually relate in the real world. It knows that this specific customer is tied to this specific order, which is being made in that specific factory, and will be delivered by that specific truck driver.
So it's the connective tissue. It understands the relationships between things.
It understands the decisions. And once you have that map, you can build new apps on it like crazy. That construction guy said they just build what they need inside Palantir now. They don't even bother buying third-party tools anymore because they could recreate the functionality in a week.
Which explains the stickiness. I mean, once you've done that work, you can't just rip it out.
Okay, so they're conquering corporate America. But we can't ignore their roots in government and defense. What's happening on that side?
That side is also accelerating, which is unusual for government contracts. U.S. government revenue was up 66% year over year. But the really mind-blowing stuff is where software meets hardware, what they're calling warp speed.
The manufacturing work.
For the Navy, right.
Yes, a huge focus on the U.S. Navy and building submarines. They mentioned a big contract, up to $448 million. But forget the money for a second, look at the operational stats. At one shipbuilder, they used Palantir to reduce a planning task from 160 hours down to 10 minutes.
Wait, 160 hours? That's a full work month for one person, down to 10 minutes.
Down to less time than it takes to get a coffee. And this brings up a really fascinating economic idea the CTO, Shyam Sankar, talked about. It's called Jevons paradox.
I vaguely remember that from college. Refresh my memory.
Okay, so Jevons paradox basically says that when technology makes using a resource more efficient, we end up using more of that resource, not less. The common fear with AI is that if you make a planner's job 100 times faster, you just fire all the planners.
Right. The robots are taking our jobs argument.
But Sankar said the exact opposite happened. One of their customers actually added a third shift of workers.
A third shift? How does that work?
Because the AI cleared the bureaucratic bottleneck, the endless planning, the reviews, the paperwork. That was the thing holding them back. Once that was gone, they had so much shovel-ready work that they needed more people, more human hands to actually go and build the subs.
That is incredible. The AI didn't replace the labor, it unleashed the labor. It fixed the paperwork problem so the factory could finally run at full speed.
Exactly. And they're leaning into this. They announced something called the American Tech Fellowship. They're running an 8-week course to teach shipyard workers, the actual welders and mechanics, how to build their own AI apps on the platform.
You're kidding. They're teaching guys on the factory floor to be low-code developers.
Yes. They're empowering the user at the absolute edge. So the innovation comes from the person who actually understands the problem on the ground, not from some programmer in Silicon Valley. Think about the moat that creates.
It's a massive moat. If your own workers built the software they rely on every day, you are never, ever replacing that system.
Never.
Speaking of moats and strategy, Alex Karp, the CEO, he was really on one this call. He seemed to be taking a victory lap, talking about the haves and the have-nots.
He was very direct about it. He basically sees the world splitting in two. The haves are the U.S., Israel, companies and countries that are using this kind of AI to reindustrialize. And the have-nots are, in his view, places like Europe that are getting stuck in regulation and falling behind.
He's framing it as almost an existential competition. And he also took a shot at his competitors, didn't he? Something about steak dinners.
Oh, yeah, classic Karp. He blasted the traditional enterprise sales model, where you win deals by taking clients to fancy dinners and golf outings. He called it event planning. He basically said, look, you can pay them for a steak dinner, or you can pay us for software that actually works and delivers results. It's a jab, but it really speaks to that shift in what customers want. They want ROI, not a party.
And that gets back to the unit economics of AI. They made a really interesting point that if you just go buy a bunch of chips and a generic language model, you'll probably lose money.
That was a critical point. They're arguing that commodity AI is a money pit. Without an orchestration layer, their ontology, to actually make it useful and profitable for the customer. They claim they're the only ones solving that part of the equation.
And their guidance suggests they don't see this slowing down at all.
No, the guide up was huge. For fiscal year 2026, they're guiding for revenue between $7.18 and $7.2 billion.
Which implies what, another 60% growth next year on a $7 billion base?
Roughly 61%. And they have the war chest to fund it. They ended the quarter with $7.2 billion in cash.
Any talk of M&A with all that cash, buying up smaller companies.
Karp shut that down immediately. He said their culture is too thick and dense to acquire anyone. He essentially said buying another company would just drag their metrics down. All growth is going to be organic.
That's a bold stance. Usually Wall Street is begging you to go on a shopping spree with that much cash.
It's bold, but when you're growing at 70% organically, it's pretty hard to argue with them.
Okay, so we've hit the historic numbers, the industrial boom, the defense acceleration, and Karp's vision. Let's pivot to our favorite segment, the theoretical trade.
And we have to say it.
We have to. This is not financial advice. We are just connecting some dots here. Please do your own research.
Seriously. Okay, so what's the idea?
If we believe this whole narrative, right, this industrial AI thing is real and Palantir is the OS for the reindustrialization of America, what's the trade?
I'm calling this one the Rust Belt Renaissance, long short.
Rust Belt Renaissance. I like it. Break it down for us.
Okay, the long side is a pair trade. First, you obviously go long Palantir, PLTR. They're the architect of this whole thing.
Yeah.
But then you also go long a basket of the old school heavy industrial companies.
The metal bashers.
Exactly. Shipbuilders, defense contractors, heavy machinery companies, the ones actually building things.
But why them? Aren't they traditionally low-margin businesses?
Because of that Jevons paradox. If Palantir's software allows a shipyard to suddenly run 3 shifts instead of 1, that shipyard's profits are going to explode.
Yeah.
The value gets shared between the software provider, Palantir, and the asset owner who can finally run their factory at 100%.
That makes perfect sense. It's a bet on the physical economy getting a massive software upgrade. Okay, so that's the long side. Who are we shorting?
You short the middleman SaaS companies, all those little boutique vendors that sell niche workflow management tools or pretty dashboards.
The ones that just show you data but don't really help you do anything with it?
Precisely. They're the ones Karp was making fun of with his event planning comment. Their entire product is just becoming a feature that someone can build inside Palantir in a weekend. They're getting absorbed. So the trade is simple. Long the submarines, short the dashboards.
Long the submarines, short the dashboards. I love it. It's a perfect encapsulation of capital flowing from digital fluff back to hard physical production. It's a savage take, but the numbers from this call seem to support it.
It's a divergent thesis, and that's what this kind of earnings report can give you, a reason to bet on the real things and the software that controls them.
Well, there you have it. To wrap this all up, this Q4 print from Palantir really does feel like a major inflection point. We talk about AI hype a lot, but seeing $2.3 billion in free cash flow and 137% commercial growth, it feels like the hype is over and the real deployment is just getting started.
The gap between the AI haves and the AI have-nots is widening, and it's widening fast. Palantir is making a very strong case that they are the essential operating system for the haves. It's going to be a fascinating year.
It certainly will. Thanks for listening to this deep dive on Talk Tickers. We'll see you at the next bell.